Good afternoon, good day, wherever your time zone is. This is Jim Kenny reporting here, and it is the weekly update from the OptionProfessor.com. With regards to the date here, it is going to be December the 14th. Basic introduction on myself. I'm a graduate of Boston College, and I've been educating people on the uses and risks of options for decades. And I'm going to share with you, as I always do, my views and my opinions on a wide variety of things, including the stock market, interest rates, gold, the dollar, and oil as well. So we're going to cover quite a bit. And again, as I say on every broadcast, past performance is not necessarily indicative of future results. There is substantial risk of loss in short-term trading as well as option trading, and it's not right for everybody. So make sure you consult with your financial people, your clearing firm, and your good common sense before you consider any investment at all. Okay, now what I'd like to do is review what's going on because, as you can see, the market is dropping again today. If you were with me on Monday when we were down at 2580 or so on the S&P, I was telling you that the market looked like it was blown out a bit on the downside, and a very sharp rally may very well ensue, particularly on stocks like 163 on Apple and things like that. That's exactly what happened. We got a very big move to the upside. But I also said that the rally could be short-lived because there's golden death crosses on all the major indexes, meaning the Dow Jones, the Nasdaq, the S&P, the transports, and the Russell. That's pretty much the full Monty on the stock indexes, and they all have the 50-day underneath the 200-day, and that's not the environment to be thinking there's going to be big sustainable rallies. So we did get the big rally. Now we're rolling over a little bit, and now we're going to try to see what'll hold. As I also said on Monday, in 2011 and 2015 was the last times that we saw a pretty good sized breach of the long-term moving average that I watch on the monthly graph. And the direction of this moving average remains up. So again, I'm not going to get terribly negative on stocks while recognizing that we've had a big drop and that we either are at an area where it's going to stop, or if this area breaks, we could go down towards the 2400 area. And that, of course, would be the next spot where it might drop. Because in 2011 and 2015, when we did get a breach of this moving average, the S&P did go down as much as 200 points underneath the average. And the average is right around 2600 plus or minus. So that was where I'm getting my 2400 number if it goes down. I've also been telling people who've been coming each week, particularly when the markets were very high and overbought, that you should consider and learn how the collar strategy works in options, which is simultaneously selling calls and buying puts in a way of trying to generate cash to pay for your insurance. Obviously, those of you who've investigated that and acted upon it when things like Amazon were at 2000 or things like Apple were at 220, 223, are obviously very happy today that you took the time to investigate because you would have been able to offset most all of this risk that we're seeing in the market right now. But those of you who are thinking about panicking out down here, you also may consider another option strategy, which is a leap or a long-term call option. Some of these companies that are going through rocky roads right now may be temporarily going through it. Again, the moving average that I look at on the monthly graph is rising. So this could just be a big shakeout before things get back on the bicycle. So if you're concerned about, the heat that you're taking on your equity, you could have a limited risk situation on your stocks going out a year or two with call options. If you price them out, if you think this is a viable strategy, this might be a way to replace stock risk with limited risk options. So you know exactly to the penny how much you're on the line for and exactly how long you've got to see the market recover. It's an alternative strategy to seeing hundreds and hundreds of thousands of dollars go out the window by owning the fully paid stock, but while also still locking in prices for a period of time. At any rate, these are some of the things that I have been covering, and I'm going to go over the markets for you right now and give you some other views and observations. Again, the Chinese have come out with some numbers, and they're not the prettiest numbers you ever want to see. So that's why the market is obviously concerned. China's weak. Looks like Europe is kind of weak, and then we're weakening. So the story for buying stocks isn't looking very good, and that's why we're down 300 and change today. In addition to overall being down. Now, the other thing that's concerning is that the Russell and the transports, which in my view led us to the upside, also led us to the downside. They have been under pressure, making new 52-week lows. The S&P's 52-week low is at 2530. So if we're going to be making new 52-week lows, and there you go, here's your transports. I'm showing it to you right now. There is a case to be made that there's a lot more downside to the S&P if we're going to be going anywhere near the 52-week lows or breaking them. Can you see the transports? You know, when you give up the faith in the transporting of goods and services, sometimes that's not a good sign on the economy. Clearly, in this case, it's not at all. It led us to the upside, as you can see, when we went to 11.5, also led us to the downside once it broke underneath about 11,250, and certainly when it broke under 11. So again, though, we are going to be starting another leg down. If we are, it could get a little oversold down here. I'm going to show you the VIX in a minute, and that'll give us some more information on that. But that's not good when the transports are making new 52-week lows. Let's look at that Russell. That's your 2000 Russell 2000. And that's another one here that's probably making two. Well, let's see. Nope. Yep. The low. Yep. New 52-week lows here today at 1422. The moving averages on this thing is up at 1600. So we're getting a bit oversold basis the moving average. So any reductions from here is just going to exacerbate the relatively oversold condition. You know, it's about 10% or so, or getting to be more than 10% underneath its moving average. If it gets to 20% or better on anything, I'm always looking for a possibility of swinging back towards the moving average. I'll give you an example. When Apple was at 2050, its 200-day moving average was in the 1500s. 500 points above its 200-day average is too much. You saw what happened next. Right back to the average and through it. So again, Amazon, again, at 2050, way overbought, and it came back down. This thing here is now on the other side of the coin. It's getting way under the moving average, and that opens the door for the bear market rally. Okay, so anyway, there's your Russell, and so those aren't good things. And now let's take a look at your S&P. Again, married puts, collars, these are defensive tactics. Replacing stocks with long-term calls is a defensive tactic to consider to try to, shall we say, stabilize your equity. But again, they all have specific risks. They all have specific designs, so you have to understand how they work. If you have questions on anything like that, my email is optionprofessor@gmail.com. OptionProfessor @gmail.com. Shoot me an email, give me your contact information, and I can discuss some of the uses and risks so you have a better understanding how they work. That, along with your clearing firm information and other information, should suffice to make sure you're aware of the risk and the use of the strategies. Okay, now you're at the S&P. So let's take a look here. We're at 2619, down 30 points. But look at the 52-week low, 2532. Nowhere near it. So are we going to blow out this 2580 that we just made earlier this week? If we do, like I say, blowing out the 2520 is not out of the question. And going down to it would probably be a high probability, of course. So if you take out 2580 there, 83, which was the low this week, again, you could be looking at least testing the 2532 and taking that out, possibly making new lows. And again, as I'm warning you, my research is that the long-term moving average is still rising, which is good for stock, but we certainly would prefer it to be above 2650 and 2700 to be more comfortable with a bull side. But if we do take out this 2580, it opens the door for going 200 points lower than the moving average, which again is where I'm getting my 2400, 2430. Some people are saying 2350, but you know, that also opens doors to things like Apple in the 140, 150 range as well. All right, let's take a look at the VIX. Okay. VIX is your volatility measure measurement. If you've been listening, and by the way, this broadcast is free of charge. If you have any friend or associate who's in the market who'd like to get a vantage point that they're not hearing, who wants to hear about defensive tactics as well as offensive tactics, this would be a good a podcast to refer them to. And again, it is free of charge, so it's a pretty good deal, obviously. I have no axe to grind, so I try to give you the facts as I see them. Okay, so the VIX being at 2157 is either very good, meaning that it should be much higher during this kind of drop, or it's telling us that there's a lot more to come and we haven't had that blow off to the downside. With the transports and the Russell making new 52-week lows, my suspicion is that there's a spike up coming. Doesn't have to be that way. And we are still holding that big important moving average that I talked about around 2,600. So again, I don't want to get real bearish right where it's next to the 2,600 support, right? But I have to recognize that the momentum on these markets is to the downside. And this VIX, while some might say this is actually bullish that the VIX isn't above 25, and I might agree with them to that effect, particularly if we don't take out 2,600. I don't want to get real bearish where we can't take out 25 on the VIX and we can't take out 2,600. But the other information that I'm looking at on the Russell and transports are indicating me that it will be doing that. So you have to be careful here, and you have to be patient. And again, you might want to look for ways to stabilize your equity here, or have some kind of a defensive situation. Sometimes you have to buy insurance during a rainstorm, and if it stops raining, you're going to lose that premium. You're going to lose that insurance put. But when you go to bed at night, at least you're going to know you have an umbrella over you where it's clearly raining. The only question is it going to turn into a typhoon or not? With regards to this VIX, though, again, if we break above 25, well, the high recently was 25.94. Okay, you see that right there? We start taking those highs out, it puts 30 into play, it puts 35 into play, and if it puts 30 and 35 into play, then we are going to blow out to the downside and probably see a very precipitous drop where the S&P catches up to the Russell and catches up to the transports, which have already made new 52-week lows. Okay, so it's a very critical time. Personally, again, if you've been listening to the broadcast, you were well informed that the market was overbought. You were well informed that it was rolling over, and you were well informed that the collar strategy should have been something you would investigate, and that would have mitigated much of all of what you're looking at here. After the window's broken and the flood has happened, it's hard to make tactics that make sense because the whole house is getting flooded. Okay, but again, the long-term call option and some type of a put option underneath, are two defensive tactics that I would be looking at if I was concerned about stabilizing the equity in my account. All right. So there's your VIX. And again, my feeling on the VIX, if you're under 15, you're in a nice uptrending market. If you're between 15 and 20, you're in a stabilizing market. And whenever you're above 20, you're in the red zone, meaning if you're above 20, it could blow off to the upside, which means a precipitous drop can occur when you're above 20. Okay, so we are above 20, and that's why you have to give legitimate attention to the concept of a drop. Okay, let's look at some popular stocks like the FANGs, at least. We'll take a look at those. Facebook today. Let's see what's going on with Facebook. Again, their problems with their data usage and all that kind of stuff. But it is a stock that went down to 126.85, and it is a stock that has been stabilizing. So let's see how this 126 holds up. The longer it holds up, the better. Seems like there's some resistance at 150. If you can get above 150, you might make some kind of a case that it's getting back on the bicycle. Again, let's take a look at the moving averages on Facebook. Okay, the moving averages on Facebook are 50 days 143. We're getting above it. That's good. But the 200 days at 170. So a lot of these companies, even if they go on a little bit of a rally, they've got an overhanging cloud now that is descending. And that is your 200-day moving average. And a guy told me a long time ago, don't fight the tape, and don't fight the Fed. And those are pretty good advice as far as general rules on the market. And the tape right now is not that great, but again, it is getting a bit oversold. You know, when we went down to 126, you're 50 bucks underneath almost the 200-day average. So you're going to get a throwback, and that's what you've gotten. How far this throwback will go, who knows? But the bottom line is that when you get way overbought, oversold, underneath your moving average, there is a propensity to possibly gravitate back up, and that's what we're seeing. Let's look at a banking stock that is also under a lot of pressure, like Citigroup. And Citigroup is, again, making new 52-week lows here today again. Yield is 322. A lot of that, and have been saying the banks are where you want to have part of your money. That's been lousy advice this year, as you can see. 80 bucks down to 55 is not exactly where you want your equity. But now that we're down here, these people have some exposure to Europe. And of course, Deutsche Bank over in Europe is having nothing but problems. So that's one of the things dragging down Citi, and also having some problems with some of the other international banks. So bottom line is that this thing's getting a little bit oversold on the downside, but again, it's making new 52-week lows. Again, the yield's pretty good. I think the moving averages are in the 65 to 70 range. So it is getting underneath the average pretty good, but that doesn't mean there can't be another shoe to drop. So you have to be careful here because you are catching a falling knife. Okay, let's take a look at the oil area. Anadarko. Another one that really gave it up, huh? Was up at 75. Everybody loved it. Now it went down to 50. It's trying to stabilize at 50. Oil's dropping again today because of the weakness in China and the weakness in Europe as well. So there is some reasoning for this, but we do have a low that's been created at around 47 there. 47, well, that's the 52-week low. Recently, probably about 49. So if we can get above 55, you know, that would be something that would be telling me that there's a possible turn down here if these oil prices are going to be able to recover. Again, U.S. is producing a ton. You got OPEC tons, and you've got alternative fuels. And bottom line is the landscape for energy is not the greatest, and that's why it's having some trouble here. Okay. Again, that's a little example of an oils thing. Let's look at healthcare because that has been supposedly the big thing going on here. Hold on a second here. Hold on here. We're going to try to get United Healthcare up. See if I can get United Healthcare. Here we go. Now, this stock has been a moneymaker, but let's see what's going on here. So United Healthcare, big move. It's been going up here for a while, but it does look like it has hit a little bit of a bump in the road. So you can see it's, but it's still overall in an uptrend, providing we can stay above 260. You start taking out 260 on United Healthcare, and I think that'll put everybody in the toilet here. But right now it's been good. You know, you might ask what sectors have been hanging out pretty good, and the two that hang out here that have been doing well in the last few months, one is utilities. Here's the Vanguard Utility Fund. So if you ever wanted to hide out from this thing, Vanguard Utility is just one of them. There's many ETFs out getting 3.25 yield, and you've got a market that is actually higher. So if in the last few months you've had all your money in utilities, you're not that unhappy because the month of October was terrible and you had a rally, and November stunk and you had a rally, and now December stinks, and at least you've been somewhat stable to higher while you're getting 3.25. So if you want to know where you're hiding out and not losing your shirt, utilities is the one. Okay. The other area is REITs, and in the REIT area, one that I watch sometimes is Annaly. And then there's many REITs out there. I'm just looking at one here. Okay. And as you can see, this 0.75%. And if you've been hiding out there in the last 3 months, let's see how your equity's been doing. Well, let's just see here. In October, it was about flat. In November, it was rising. And in December, it's been rising. And while your equity has been rising, you've been collecting 11.75%. Not the worst place to be in the world while everyone's losing their shirt and everything else, right? So I just showed you two places where people are hiding out, and they're doing pretty good hiding out in those two sectors. Okay. Like I say, if you know who are in the market, who are trying to do everything on their own, who want to be self-directed on everything, God bless them. But they may need some information from time to time, and I try to provide you the best I can. I've been doing this for decades. I didn't just fall off the turnip truck, so you should try to take advantage of these free podcasts and also distribute the availability of the podcast and how to get the link at OptionProfessor.com to your friends and associates. Okay? All right. Let's take a look at interest rates because we got the Fed meeting next week. And of course, that's the big news, right? Well, let's just see what that bond market's been doing because I've been trying to bring it to your attention every week. Now, as you can see, interest rates have been rising, right? So there you go. It goes up to 3.25 almost on the 10-year. Then it comes, this is the 10-year treasury, comes back down, goes back up. And now because of the market sell-off, we've come back down. Okay, but it is holding the 280 area. See the 280, 270 area? It's been holding. As long as we hold the 270, 280 area, I still believe that interest rates may go back up. A lot of people are not saying that now because of the weak economy. But here's my point, okay? Like Jamie Dimon was saying, the guy who runs JP Morgan, the economy looks good. The consumer is employed. The consumer is spending money. Retail sales just jumped 4.2%. That's not nothing. Now, of course, margins, because they may be cutting their prices, to gather all these sales, maybe the margins to these companies has not been great, but that consumer and money velocity is still rolling. So again, wages, another thing, right? You're looking at wages that are going 3% or better. Fed funds is at 2%. You can't have Fed funds at 2% with inflationary numbers at 3 to 5% because healthcare is running up right now at 0.4, which is almost 5% increase in healthcare. Again, on the positive side, obviously oil has dropped, okay, but food is up, rents are up, healthcare is up, and wages are up. And I'm saying that my belief is that these rates are going to be going higher next year because the inflationary numbers are going to pick up, and that is going to put the Fed in a position where they're going to have to defend. And a defensive situation means they have to normalize interest rates. And 2% Fed funds is not normal when you've got these inflationary numbers above 2%, right? Right. Well, that's my feeling. Now, with regards to the Treasury, also, the supply of treasuries, we put 1.3 trillion new money into new borrowing. On top of the ordinary borrowing, we've added 1.3 trillion of new money in borrowing. So the deficits are going nuts, okay? And normally we don't have big deficits when we're in a great economy. So, you're running great deficits while the economy is great. What do you think the deficits would be if we had a contraction? They could go off the rails, right? And all that supply has to be bought by somebody. And you know what we're doing out there politically? We are ostracizing all the people who buy our stuff, buy our debt. China, Europe, 40% of our creditors are the guys that Trump is picking fights with. That is probably not the great idea. People who you owe money to and now you're busting their chops. That might not be a good strategy, no matter what the headlines say. So the bottom line is, and also the increase in the high yield market. Let's look at these. I'm going to show you two things that I'm worried about that you should be aware of. One is floating rate, which is leverage loans and things like that. Fidelity has a fund that I am very aware of because I used to be involved in it, but I got out. Why'd I get out? Well, look at a chart. Once it got on, it was these are short-term paper, floating rates, which is leverage loans, and people want out of these things, don't they? Can you see the chart right there? People want out, okay? And they want out in a big way, right? I don't think that's the beginning of the storm. I mean, the end of the storm. I think that's the beginning of an exodus. Now, let me show you another one, which is high yield. People want to know where the bubble is, just like Jamie Dimon said. If there's any bubble out there, it's in debt. Because why? Let me explain something. When people want to sell leverage loans or they want to send high yield bonds, sell high yield bonds, other dealers are the guys who are on the other side of the trade. When you want to go sell Apple or Amazon or something like that, there's another investor out there who might want to buy, right? But when you want to dump all this debt, other dealers are the buyers. Now, if the other dealers already own this junk and they're trying to get out as well, they're not going to be putting a big bid out there for more of the junk they're trying to get out of, right? So that's why there's a problem with liquidity in these high yield bonds and in these leveraged loans potentially, because the only buyers of them of size are the same guys who own them already. So that's a dangerous thing. And that's how you can have some type of a crisis. Again, Deutsche Bank is having some type of a crisis because the stock, if you look at the stock, has been collapsing. And that's, I think, the biggest bank in Europe. Okay. So as you can see from high yield, it is dropping as well. And again, it's stabilizing down here a little bit, but I still think there's significant risk to this stuff looking forward because, like Buffett says, when the tides change, you find out who's swimming naked. The tides have changed in the interest rate market, and now we're finding out who's swimming naked in leveraged loans and high yield. So beware of that and be cognizant of that. Okay, I'm going to go over a couple more things here for you. The US dollar, big thing, right? Okay. US dollar 97.50. And as I've been telling people, it's been trading between 98 and 96. Breaking under 96, that would be a warning flag on the US dollar. You start breaking under 94, that's a red flag on the US dollar. So be aware, if it starts breaking under 96, starts breaking under 94, I would then look at something that has been out of favor for a very long time, but might be something of value. And that is the gold miners, GDX. GDX bottomed at around 17, went up to about 20, came back down here to 18. Now it's making another little new high. If we can get above this 21 area, you see where my cursor is? Those are lows. If we can get above 21, this thing could be turning around. The moving averages are starting to converge and turn. So keep an eye on this because this is something that's been out of favor for a very long time. Look at that graph. Look at that graph on the left. Okay, it's been out of favor for a long time. Dollar starts dropping underneath those levels that I talked about. People could start looking into the gold again. And right now, look at all the moving averages converging right around that 20 number. So that's where I'm getting. You get above 21, 22, and certainly if you get above 25, then it could be off to the races. This could be the big story for next year. It needs to get some momentum. So we are early to even talk about it. But it's better to talk about these things early, like Amazon might drop when it's at 2050 than to talk about it when it's already dropped at 1400, right? Right. Okay. Let me go over a couple more things here. And let's just see one other thing. Soybeans. Why would I be talking about soy? Supposedly, China's back on the bicycle buying it. So let's just take a look. Let me see if I can get this for you real quick. Some of you people out there might be trading in the commodity sector, and this might be something worthwhile to keep an eye on. Okay. All right. All right. As I was telling you, it's been having a lot of resistance at start. It could get us going, but really 950 is the number. So closing above 950, that's a lot of volume here, and we couldn't get above 950. That's not that great. So again, I would be a little bit more patient because if it gets above 950, going to 10 might happen pretty quick. If it can't get to 950 and China starts reneging or whatever they're going to do, this thing can go right back in the tank. Okay, but it's something to watch because it has picked up a little bit of steam, but it could be a fake little move here. Be careful, keep an eye. All right, I'm going to wrap up now for the week. Again, I do encourage you to send an email if you have any questions to OptionProfessor@gmail.com. And again, we didn't get a chance to go through all the different sectors because we only have the half hour to give you. So again, other questions or any comments, you shoot me an email. I'll be more than happy to help you. Until next Friday, again, this is Jim Kinney for the OptionProfessor.com weekly market update. Until next Friday, good luck, good trading, enjoy your weekend, and I'll be back with you next Friday.